Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over traditional IRAs. And we're going to be doing that the SuperfastCPA CPA way, which is diving straight into questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour training webinar where we go over the key ingredients to passing the CPA exam. Again, it's 1 hour, it's free, and it will save you so much time struggling with your process. Make sure you go check it out. The link will be in the description. Also, just letting you know, we will only be going over 5 questions in this video, but SuperfastCPA CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this and you want more practice, you can get more by becoming a SuperfastCPA CPA member. One more thing before jumping in, this is the first video in a short series where we're going to be talking about retirement accounts for TCP. So as you watch this video and the videos that follow for the next few days, be looking for the differences between the different retirement accounts, the different advantages, the different disadvantages. All right, let's go ahead and dive straight into the questions. All right, here is the first question. Which of the following sources of income is considered compensation for the purpose of making a deductible contribution to a traditional IRA? Okay, so what counts as income that qualifies you to have a traditional IRA, basically? If you don't know, that's okay. We're going to dive straight into the answer for this one so that we can start learning. Okay, and the answer is that alimony received under a decree in effect before 2019 counts as compensation for a traditional IRA. So let's learn about this. For traditional IRA contributions, compensation is defined as money you earn from working. This includes wages, salaries, commissions, self-employment income, and non-taxable combat pay. Some other specific forms include alimony received under decrees in effect before 2019 due to changes in tax law. Just a reminder, after 2019, alimony is no longer considered taxable income for the person receiving it, which is why there's that distinction there. Alimony received under a decree in effect before 2019 is considered compensation for IRA purposes according to previous tax laws. Interest income, rental income, and capital gains are investing earnings, not earned income, and do not qualify as compensation for IRA contributions. So there's an important distinction there. Not all income is qualified for someone to be able to contribute to a traditional IRA. They have to have something other than investment earnings. Okay, let's go ahead and go to the next question. Okay, here is question 2. At what age are individuals eligible to start making catch-up contributions to their traditional IRA, allowing them to contribute beyond the standard annual limit? So there is a standard limit each year that somebody can contribute to their traditional IRA, but after a certain age, they can start contributing a little bit more because they're getting closer to retirement. So what age is that? If you already know, that's great. And if not, let's go ahead and look at the answer. Okay, 50 years old. Pretty simple, this question. We just needed to know that after 50 years old, you can start contributing extra to your traditional IRA. And again, this is called the catch-up contribution. Catch-up contributions are additional amounts that individuals who are 50 years old and above can contribute to their traditional IRA. For example, in 2024, this year, this is $1,000. We're not going to talk about the specific numbers, but again, this is, for example, it was $1,000 in 2024 if you're watching this in a later year. And like I said, this is designed to help those nearing retirement to boost their retirement savings. Okay, so we learned some really basic things about traditional IRAs. Now let's dive into calculating some of the different pieces of traditional IRAs. Okay, here is question 3. Sarah, who is 55 years old, withdraws $70,000 from her traditional IRA. Her adjusted gross income, AGI, for the year is $60,000. She allocates the money as follows: $20,000 for medical expenses, $15,000 for her daughter's college tuition, $10,000 for a first-time home purchase, $15,000 for a vacation, and $10,000 for purchasing life insurance. So we need to calculate the amount of the early withdrawal that is subject to the 10% penalty. Okay, so apparently she's withdrawing too early, and we'll learn about at what age that is no longer a problem, but there's a 10% penalty for the amount that she withdrew, but maybe there's some things that are okay that she withdrew the money for. So if you know about this, go ahead, pause the video, do the calculation. If you don't really understand how this works, that's okay. Let's dive straight into the answer to start learning this calculation. Okay, so the answer is $29,500. And again, this is the amount that's going to be subject to that 10% penalty. So let's read about this. When withdrawing from a traditional IRA before age 59 and a half. So okay, that's the specific number right there. After age 59 and a half, there's not these withdrawal penalties, but beforehand, there are these penalties. but there are several exceptions that allow you to avoid the 10% early withdrawal penalty. These exceptions include using the funds for unreimbursed medical expenses that exceed 7.5% of adjusted gross income, paying for higher education expenses, first-time home buyer purchases up to $10,000, and certain insurance premiums for the unemployed. Each of these exceptions has specific requirements that must be met to qualify for the penalty exemption. So based off of all that, based on the exceptions to early withdrawal penalties from traditional IRAs, Sarah would have the following amounts exempt. So $15,500 from her medical expenses, as this is the amount that exceeds 7.5% of AGI. And let's think about that for a second. So her AGI, let's go back and look at this, was $60,000, and then there's $20,000 of medical expenses. So let's do a little calculation on the side here. So 0.075 multiplied by the $60,000 of AGI, that gives us $4,500 of medical expenses before she meets the 7.5% AGI or higher. So we subtract this $4,500 from the $20,000 of medical expenses, and that leaves $15,500 of medical expenses that are exempt from the penalty. And then there's the $15,000 for the higher education expenses directly applied to her daughter's college tuition. So that counts because, again, it was paid directly to the college. Then there's $10,000 for a first-time home purchase, which is exactly the amount that she can use for that. So all those are exempt. These specific allocations avoid the penalty, while the remaining amounts would be subject to the penalty. So there's the $4,500 of medical expenses that were below the 7.5% of AGI. Then there's the $15,000 for a vacation. That one's pretty obvious. And the $10,000 for purchasing life insurance. And again, that's not one of the things that is exempt. So all of those together are subject to the 10% penalty, but all we needed to know for this question was how much was going to be subject to the 10% penalty. So that's $29,500. So overall, in this question, we learned that if you withdraw money from your traditional IRA before 59 and a half years old, you can be subject to a 10% withdrawal penalty. However, there are certain things that are exempt, as we learned in this, and then whatever isn't exempt is subject to that 10% penalty. Let's go ahead and look at the next question. Okay, here is question 4. Michael, age 72, has a traditional IRA with an account balance of $200,000. According to the IRS RMD tables, he was required to withdraw $7,300 this year. However, he only took out $3,000. Calculate the excise tax Michael will incur for not taking the full RMD, or by the way, RMD is required minimum distribution. So we need to calculate the excise tax. If you don't really know how to do that, that's okay, because again, we're trying to learn the rules here. So let's go ahead and look at the answer to figure out how to calculate the excise tax. Okay, and the answer is $2,150 is the excise tax, so let's learn through this. The IRS mandates that a 50% excise tax be applied to the amount not distributed as required. This is to enforce the RMD rules and ensure that retirement funds are eventually drawn down. This penalty can be reduced to 25% or even 10% if it's corrected within 2 years. However, we're not really focused on that for the CPA exam. You may see some questions that mention that, and it goes down to 25%, but overall it's 50% excise tax, again, unless it's corrected within 2 years. So to calculate that excise tax, we take the required minimum distribution that it mentioned, which was $7,300, take the actual distribution and subtract it from the required distribution, leaving $4,300 left that he should have distributed. So there's an excise tax of 50% on that, leaving $2,150 of tax because he didn't withdraw the required amount. So, by the way, this age right here, age 72, is the age where required minimum distributions for traditional IRAs start to happen. So the IRS requires that somebody who has a traditional IRA, if they haven't taken any distributions up to the age of 72, they are now required to start taking distributions 72 and onward. And again, if they don't take out the required minimum distribution each year, they're going to be charged a big excise tax on the amount that they didn't withdraw. So that's one big con to traditional IRAs. Let's go ahead and go to the next question. Okay, here is question 5. Which of the following scenarios best describes the characteristics of a traditional IRA? Okay, we've learned a little bit about this up to now, but there are still things that we don't know. So if you know or you kind of can figure this out, go ahead and pause the video and select the answer that you think is correct. But if not, that's okay. We're going to go straight to the answer to learn more about traditional IRAs. Okay, so The correct answer is that John is the person who has a traditional IRA. That's because he contributes $6,000 annually to his retirement account. His contributions may be tax deductible depending on his income, filing status, and whether he is covered by a workplace retirement plan, and withdrawals in retirement are taxed as ordinary income. Okay, so let's read through all these, and it's going to kind of explain some of the differences between traditional IRAs and the other things that were mentioned. So again, B is correct. It's a traditional IRA, and that's because the contributions are tax deductible, the distributions are taxed as ordinary income in retirement, and those are the big things that sound like a traditional IRA. A describes a Roth IRA where contributions are made with after-tax dollars and qualified distributions are tax-free. Now, we're going to talk about Roth IRAs in the next video, but that is a big difference between Roth IRAs and traditional IRAs. Traditional IRAs are made with pre-tax dollars, which means that money, when you take it out, is taxed. Whereas with Roth IRAs, you're putting in after-tax dollars, so that money's already been taxed. So later on when you take it out, it's not going to be taxed again. C might resemble a combination of features from different types of accounts, but does not correctly describe a traditional IRA, especially the ability to take loans, which is not a feature of IRAs. And then finally, D introduces elements not typical for any IRA, such as direct tax credits for contributions and specific reduced taxation rates on withdrawals, which are not characteristics of traditional IRAs. So traditional IRAs, they're fairly simple. There is a contribution limit each year. We didn't really go over that because that is something that changes each year. So you'll have to learn that from your review course, what it is in the current year. But you put in pre-tax dollars, it grows tax deferred, and tax deferred means you will be taxed on it later, not right now. And then when you take the money out, it is, again, taxed as ordinary income because you haven't paid taxes on that money yet. That's the basic gist. So before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice things and topics and calculations that keep coming up in the questions that you're doing. These are the things that you can tell are obviously important because you've done them multiple times. So you write these down as pillar topics so that you can remember them and know them for later. Let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics. And there's quite a few because there's a lot about traditional IRAs, so let's go over it to make sure that you know everything you need to know for the CPA exam for traditional IRAs. First off, contributions to a traditional IRA can only be made if the individual has earned income. And again, we went over that in the first question. This includes wages, salaries, commissions, self-employment income, and even alimony received under decrees in effect before 2019. Now, here are some of the advantages of traditional IRAs. It's tax-deferred growth, so you don't have to pay taxes on the money you put in until later. Investments in a traditional IRA grow tax-deferred, meaning taxes on dividends, interest, and capital gains are postponed until funds are withdrawn during retirement. And then contributions to traditional IRAs may be tax-deductible depending on the taxpayer's income, filing status, and coverage by workplace retirement plans, potentially reducing current taxable income. So that is one advantage, is even though you're putting in pre-tax dollars, so you're going to be taxed later, in the current year, you can potentially take deductions for the amount of contributions you put into your traditional IRA. And again, we didn't go over that too much because that specific calculation isn't necessarily something super prevalent in the CPA exam, but you need to know that that is the general idea. And then as far as disadvantages of traditional IRAs, it is taxed on withdrawal. It's taxed as ordinary income, and that is a really big disadvantage if you're in a higher tax bracket especially. And then another couple big disadvantages are the penalties for early withdrawal and required minimum distributions. So early withdrawals before age 59 and a half generally incur a 10% penalty, and then starting at age 72, holders must take minimum distributions or incur an excise tax on the amount not distributed. And then finally, kind of going back to the penalties, certain situations such as unreimbursed medical expenses exceeding 7.5% of AGI, qualified higher education expenses, first-time homebuyer purchases up to $10,000, and certain instances of unemployment where insurance premiums are paid are exempt from the early withdrawal penalty. So there's a lot of information about traditional IRAs in this video, so I hope you learned a lot. Thank you for watching this video. Make sure to go check out our free 1-hour webinar training on SuperfastCPA.com. Again, it's only 1 hour and it's free, and we will teach you the key ingredients to passing the CPA exam. Also, if you liked this, going through these 5 questions, just remember that Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So you can get more practice by becoming a Superfast CPA member. Be on the lookout for the following retirement plan videos where we're going to talk about other retirement options so that you can start comparing what you learn in each video to know the advantages and disadvantages of different retirement accounts. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.